Testing. We're testing audio. Messed up on the first one. Test. 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 Okay, I think we're good. Um, Welcome back. We're doing self-storage, multi-fund, and by multi-fund it means we're looking at the equity requirements of scaling into um, self-storage, a self-storage business, going into the doing it as a fund potentially with all equity, with a sponsor and investor joint venture, and we're looking at doing that, exiting, doing another one, and up to 6 times. And you can control all the months between everything, and it's got waterfalls, monthly waterfalls for every single up to 6. And what's cool is we're going to be able to see with the starting cash amount, we can see um, what this looks like over time, how much money is going to have to be contributed, how much money is going to be able to be made, all on one timeline, up to 10 years. So right now, where we are in the modeling process, I've done Fund 1 and 2. All the logic works fine. It was very difficult to get the cash flow from the joint ventures because these all have to be on their own. Like these timelines are their own kind of standalone module, but they all have to fit back into these monthly details 1 through 6. And right now, I've done 1 and 2. You see how 1 starts here based on the assumptions. Number 2 starts over here. So this timeline all has to be the same so I can aggregate it here. And then I'll aggregate it on an annual basis as well. But the monthly is the most important to finish. So this is going to show how much cash is needed. If you just put 0 here, then obviously the negative amount is the max cash you're going to need to make this work. And then as you exit, do a new fund, um, exit that, and then we'll do another one and so on. So this is a nice way to see the timing and strategy of that. By the way, if you want, like and subscribe. That helps me a ton with the YouTube algorithm. Uh, Also, check out smarthelping.com. That's where I have 100 plus unique financial models built in Excel, some in Google Sheets. And it's not just financial models, it's mostly financial models, but it's also some tracking and database stuff, some best practices with that. All right, so what I have to do now is going to be kind of boring, but I want to do this all on stream so you guys can see what goes into from start to finish building one of these. So today I'm going to go with trying to finish Fund 3 through 5. This should say 6 here, 3 through 6. And once that's done, it's going to be about doing some sanity checks and some visualizations and some summaries. Okay, so, and the reason why these are all separate is because you can structure each deal differently. As you have more cash, you can kind of maybe increase your contributions, which increases your returns. Not the IRR, but increases the nominal cash amount when you go into these deals, or you could maybe negotiate better splits. So you can do that, change those every time. So we're on number 3, and what I need to do is adjust all the assumptions. So I've done Fund 1 is column D, Fund 2 is column E. Now I have to do Fund 3. And as I look at this, I'm thinking it might make sense to go out to 15 years, which I might extend this out to 15 years, which wouldn't be too hard. I think I'd have to drag these down a couple more, about 60 more rows there, and 60 across, but it's all dynamic, so I can just drag everything. It should be fine. So, without further talking, let's get into this. Right now, everything's going to column F. And I have one of these that's different. This one. As you go over, okay. And this is contained. Alright, so F. Oh, this might not take too long. F. You'll find a lot of times modeling. The fun part's figuring out the puzzles. The hard part is then sometimes you've got monotonous stuff like this that you have to do, but it's going to be worth it. You just try and do it as efficient as possible. Now the matrix tab, we're now, instead of E4, it's going to be matrix 2. We're looking at, because that was for fun 1, so fun 3 is E6. And we'll do a bunch of checks to make sure this is correct. Now see, I gotta adjust these separately on this one. And to test this, we'll have to change all the variables on the assumption to make sure we're seeing what we expect to see. And I am not talking on purpose, so don't be worried about that. I'm just getting through this. This was one of the hardest things is mapping these cash flows over because essentially you have to go from these assumptions into here, map that into this timeline, but then bring these back to the same timeline on the monthly detail in the relevant month. It was not easy to do. But you'll see the previous stream did all of that. I was doing all that on that one. All right. So that should be it, actually. Now let's check and make sure this makes sense. So we start May, well, let's go over to here. December 2025, we have the cash out. Does that make sense? Yep, December 2025. Construction lasts for 2 months, so revenue doesn't start on this one until Feb 2026. Feb 2026, we have revenue. Now, this was a very important aspect to get right for the cash flow and internal rate of return hurdles, is to get that timing right here. Now, see, this also has to change. So December 2025, we have that, and then Feb, we have revenue starting. So it captures this delay that happened if we were to put this to, say, 3 months. Now, you can see there's another month delay there before revenue starts. And then exit happens. Where's the exit? 3. So we're missing the exit. It's 28. So this exit we should have. Let's check, make sure this all works. Yep, that's right. Here should be the exit, August 2027. August 2027. Right. So I gotta put this formula in here. So I believe I can drag it over and then index 3, get the net operating income. Looking at tab 3. There it is. Also, this resulting sale price per square foot is a pretty important metric to have in here. There we go. And then you got selling fees, other fees. Net proceeds is 3.9, so we should now see 3.9 in there, which we do. That should also come into the cash flow on August 2027, which it does. And it goes through all the hurdles. Oh, we definitely need to lock this column D here. Yeah, because we need to see this over here as we scroll across. So there you can see the hurdles, tier 1, tier 2, tier 3. Same with this one. And oftentimes when you're modeling, slower is faster. Taking your time, making sure everything's right, reduces the time you have to go back and check for errors and figure out what you did wrong. And all that stuff. So if you go slow and steady, you're actually end up being faster in the long run, and it's less of a headache. Now this logic is all self-contained. All we're really pulling is the dates down to the cash flows for each of these cash flow tabs. All right, that wasn't as bad as I thought. Let's go. Let's bring this in here. So this is just equal to. Wait, why is this on 134? This is an E6. 34. Oh, right. So the sponsor. This is the general partner. And this just equals that, so it's the same. All right, so for consistency's sake, we'll take the top one. So E6, take that on here. 2, make this 6. Make sure it's the same. Yep. And then for this, so that we can just lock this, and then when we drag it down, all we gotta do is change this to a 3. And I want to zoom out on this one a bit so you can really see. You might have to do it on an annual basis. So there you've got your entry, 156,000 based on the deal, and the exit, which runs off of this. Contribution to GP is only 10%. The other ones, I think we did more. Well, 10, 20, 10. Sponsor gets 1.2. Yep. And my assumptions are arbitrary for what's driving the yellow, the tabs in yellow. I'm just putting in random numbers just to make sure the logic works. But when you do this, you'd obviously figure out what deals you're doing, plug in the data in here, and it would all update. Okay, so this is good. There's that one. Let's go to 4. Make sure we're all the way over. So now we got to go to fund 4, which is G. So we got to go make everything G. And I could do a find and replace, but I'm worried that might mess up some other formulas, and I'm not. It's just not worth the risk of time. And this, which one's different? So now we'll go to 7, G, and then this is going to be. This will be G as well. What's up, viewer? We're just doing some good old financial modeling here. We're in probably the most tedious part that we'll have in the whole thing right now. 7. 16, I think. Occupancy, let's check that one. Fund 4 is 15. Make sure that's 15, 14, 13, 12. Okay, good. And I was just saying, I wish there was a find and replace here, but I mean, I guess I could do it. Find assumptions, exclamation mark, money sign D, and change it to G. But I'm worried that might pick up something else that I don't want to change. Make sure that's E7. Yeah, perfect. Fund 4. But I imagine this won't take too long, maybe another 30 minutes or so, 40 minutes, and then I'll be on to the visualizations. The nice thing about doing an error check on this is I know exactly when the funds are supposed to start and stop. And if those don't line up, I know there's something wrong. All right, so drag these. So we drag it over, see where we are. So we're in September 2027 start, which is correct. And then revenue starts 2 months after that, November 2027. Good. And exit is, oh, I think we gotta finish updating the cash flow to get this rest of this part. So let's go do cash flow 4. So now we're on D, E, F, G, G on that one. This all goes to 4. Oh, this needs to stay at 4. I think. Let me check. Matrix 2. Is that the, no, that's the start. Okay, so no, that needs to go to 7. This was the hardest part here is this. Um, we had to use a matrix of get the right start month so we could map all the cash flows on the same timeline to their individual hurdles. And then the result of that can then go back to the monthly to get the actual cash flows after all this hurdle waterfall ran. Which is not easy stuff. All right, and then pull in the exit value, which is 4, and that's good. Selling fees were at 460, 4,068,000. So let's make sure that came in. 4 minutes 68, good. And the 86 is the cash flows for operations for that last month. That looks like a good split. Let's check this. Yep, okay, this updated correctly. 1.279 for the sponsor. Yep. These don't need to have. Oh wait, yeah, they do actually. Let's see. So why do we have a variance here? Because we should not. Cash flow 4. Hold on a second. Let's go back to 3. Did I miss some piece of logic? No, so that one's fine. We're off by 15. Let's see, what could it be? That's right. Ah, let's check this one here. So index cash flow 72, that's fine. Matrix 2 G4. What's matrix 2 G4? That's fund 1, so no, that's not right. We need. Okay, so let's see. No, that should not be G at all. Let's check this one. Cash flow, that's good. E7, that's good. Cash flow 79. E7. That looks good. Now, what did we do here? Matrix G4. All right, let's take a step back. So let's look at this, because this was definitely correct on the third. So this is E6. E6. This is E5. This is E4. So E4, 5, 6. So this should be E7, not G4. And what I think I did is I changed the E to a G instead of, I needed to keep it an E but make it 7. Assumption should be G. That's right. That's right. All right, now let's drag this over. And do we have zeros for the check now? Yes, perfect. Because this, the cash flow that's happening in this segment should match the numbers coming back from the waterfall on the relevant months exactly, which it does now. So this is saying the LPs are getting their returns until they actually, no money is split past the first hurdle until the exit in this case. Okay, looks good. Let's go back to our aggregate and pull this down. So this is now going to be to 4, and then we only got 2 left, and then this thing's going to be rocking and rolling. What's up, viewer? Working on this the logic on this multi-fund self-storage. Just mapping the last two funds here, and then we'll be on to some new stuff. So, all right, so now what are we at? We did G, now we're on, we've got to put everything to H in fifth fund. H, H. And sometimes it's just hard to talk and concentrate without making errors, so especially during this part, because this cannot have errors. All right, this one was different, so we can drag these. Then we drag, this needs to be adjusted to H. Eight. Okay, we're getting there. I'm actually excited about how quickly this is coming along. I thought this was going to take longer. So cash flow 5, we go H. H. This goes to 5. Now this goes to 8. Okay, what? Oh yeah, yeah. So May, June 29, July 29, May, July, perfect. Let's put the exit in here. Go to fund 5. Looks good. 4-2. July 2029. And what do we have the same issue again? Hold on. Index C. Oh shoot, this is 5, not 4. 5, that's E8, E8, H. This is 5. There we go. So now we're all matched up. 4, 4, 5, 5, 5. Now you can see we're running out of timeline, so let's just make these shorter just for the sake of trying to get all the data on one timeline for this. And I think I'm going to extend it out to 15 years for sure once I finish Fund 6 here. Actually, very surprised. I thought this was going to take me almost the whole time just doing this. So, okay, now I think we have time. So or space. Let's see where we end up on this fifth fund real quick. 28. Yeah, I think oh yeah, that's plenty. So you can see all these are essentially entries and exits, no cash flow in between except for the fund 2 because LP is, and here's exactly why. If you look at LP, it was an 80-20 split. So for the investor to get their return, they only put up 80% of the capital, meaning that they can get their first hurdle beat faster. Holding it all else equal, you can see the other ones are all 90-10. Oh, I gotta lock these. Let's get these locked here. 4 and 5. And 6 we're about to do. All right, last one. So now we're going to I on 6. What's going on, viewer? We're just modeling away here. Almost done with the tedious mapping of all 6 funds. About to get in some visuals and do some sanity checks. Make sure all our references are good. This is going to be a really cool model when it's done. Self-storage. Let's see, yeah, we're good there. Now, it might seem like a bit of a long time here, but it could take a lifetimes for some people to get what I'm getting done here to accomplish this with the structure and the granularity and everything. So to me, it's not that hard, or it took me 3 weeks, once a week, working on it. But it could take people, if they don't know Excel, it could take them years, and they might never actually get to the point where they can do this. And the hard part is the structure. This is the easier part as far as mental capacity. Whoops, space 6. And this last one's always gets me, so let's get it right this time. 6, 6, 9, I, and 6. All right, drag this over. Nice. Just got to the end. Now let's go to 6, cash flow, adjust this to I. This is always going to be year 0. And these all go to 6. Put in our exit. Looks pretty good. July 30th, 2031. Yep, 2031 to July, 4.278 plus the cash operating in that month. We're going down 371. Great. We don't have any issues on our matching there. Oh, shoot. Let me double check one thing real quick. So this, I want to make sure I adjusted this right. So this is 9, matrix 2, 9, right? 9, fund 6. 9, 8, 7, 4, 7, 6, 5, and really you would know even if it was off by 1 month. 4, yeah, that's good. Okay. Oh my goodness, I can't believe this. So, and if you want to see some cash flows, let's do 80/20. Oh shoot, what did I just press? Whoops. Let's do 80 on all these. Now you've got some distributions going to well, and and none of guess, except for two. So what would we do? Two would be 20. We said 85-15 split. So even though the GP put in 20, they're not getting the full 20, but they're going to get 15% of the cash flow up until the LP gets 10% internal rate of return. So that's why all these other ones are 90. So if we go 85, and if you want to do a hard pref, you could set this to 100, meaning the LP has to get all their money back plus the return before any cash is split to the GP, and then getting past that hurdle. Here we go. Now you should see some splits coming both during the operating period. Yeah. And if we look at our, yep, there you go. And technically, you could, so if you wanted to model out starting a bunch of these, like, without, like, the point of automating the start month of the new fund is that you don't want to enter a new fund until you've exited another one. If you didn't care about that, you could actually put like a minus, like, let's say -3 here, and this fund can start before this ends in theory, and that's fine. Um, so now this one ends November 2023, but this is starting August 2023. If we offset them all by -3, all that happens is now you just have bigger, let's say you don't have any money. This is going to tell you, okay, -150. Now you've got some operations, but now you're starting August 2023. You're starting another fund before the other one is exited. So now your cash goes up a little bit more, which is fine. It's just now you know how much cash you're going to need to sustain, to be able to do that. And eventually you should scale and you'll start to see um, positive cash flows. Now, to be exactly perfectly efficient with all the capital, then this any bank balance would be close to zero at all times, and it means you're fully reinvesting almost all the profits every time. And then, like I said, if you got want to see if you have some money in the bank, how far does that get you? Well, in this case, minimum equity needed equals min of ending bank balance, which is that right there. So, and this is just on, and if it's positive, it means if it's negative, it means it's a surplus. So here we're saying minimum equity needed is 206,000. If we start at 0, now we can see our total equity is 306. If we have like 325,000, we now have just enough to do all these funds, and the main cash required is going to be, yeah, see, this is about the lowest. It gets 18,000 here when you do the second fund before the first one is up. But you have that flexibility, so these don't have to be, each fund doesn't have to start after the first one ends, but it can start before it if you want, and the cash flow will reflect accordingly. So this is defining the months until the next fund is entered after this exit happens. And you can hold the month held is right here for row 65 to define how long you're going to hold in each fund. So this cash flow is just your sponsor. And you can see, if you want to see the total deal cash flow, each cash flow here is going to show, here's how much the LP versus GP is contributing. If you go to the bottom, and then what's the returns over time. So zoom back in here. I'm going to put this on an annual basis of when we're all set. So this is a nice flow here. So there, we actually need 0. We get enough for the first one, and then because we're not entering the second fund until the first one is over, we actually have enough cash to get out of that, start the new one. The new one might be bigger. You might contribute more, but that's where you can plan all this out. Now, I'm wondering in the control tab, it might be nice to set these contribution rates and resulting equity needed all in one spot. I think that's probably beneficial. So we can do so much here to make this really nice and easy to use. So let's go, these equity contributions, we'll do deal fund one. Let me see that yeah, I defined these over here. So this is going to be fund one, and we'll go all the way to 6, 2, 3. So D, E, F. And I really shouldn't be getting ahead of myself. Um, Hold on a second. Let's do a sanity check after this, or before we get into this more. All right, so fund 1 through 6. These will be configurable right at the front page, and they'll flow through, and we'll see the resulting. And here's the cool thing. So this is cash flow off fund for the GP. I'm about to do the same thing for the LP, so you can actually plan this if you were an investor looking to do multiple deals over time. How much money do you need? What's the cash flows look like? What's the internal rate of return? And our internal rate of return is going to be, if you zero out this, it would be, we'll do an XIRR of this and then convert it to a yearly rate. If you were to zero out the beginning bank balance. Oop. But before we get into all that, let's go and do, so let's do sponsor. We're going to do change this to investor so you can actually look at both sides of the deal or of the scaling process. And now instead of so control, well technically it'll be easier just to do this. So fund one, we'll go to cash flow one, and it's simple. Just go rate here. This is LP. Oh, actually crap. So we had to do some advanced logic to get this information into here. Ah, dang it. So, oh shoot. Um, wait a second. Wait a second. Wait a second. We have it here. We've got it right here. Perfect. Thank goodness I brought this in. So we can just reference E38. Perfect. So this is going to go to 1, E38. And then we lock this, and then just simply, all the hard work's already done. So 2, 3, 4, 5, and 6. And now you see the other side of it happening here. We zero out both of these. This is cool. This is very cool. Now the question is, we're going to go out 15 years, I think. So minimum equity 6, 150. So there's the contribution rates. We'll do resulting. So this is here. The other thing we want to look at is resulting. What is the resulting? Make all these the same first of all. Um, Cash required. And this is going to be, let's see, I think we'll go cash flow 1. It'll be right there. So LP. So you can see on each deal what is the equity required. And assuming you had no other funding from anywhere else. And then general partner. And if you change, we'll do this in a second. Now, if you change this, let's say the LP only does 75. Now this, oh, I gotta actually set the references. So, okay, this is gonna be light. Now this is actually a formula. LP does 75. And then this is gonna be 8, 9, 10, 11, 12. Now I was thinking about bringing the hurdles over 2 and the splits, but I figured um, those, you might as well keep those on each because it's going to get too busy on the control tab. But we can at least show equity contribution and percentage. So now it changes. So if let's say we do 90, 85, 80, 70, 75, 70, and you want to check it, so we'll just do a check here, quick check. So this 90, so 70, yep, that all checks out. And now we do this divided by it, that's 10, 30, 25, yep, looks good. So that's all working. What I do want to display here is the resulting IRR. So this is a big one here. We'll have IR, which will be in here, already in here. And we're going to do an aggregate IRR as well. So LP, these all be one decimal. All right, so now we have IRR of each as well. Also, I want to do an aggregate lifetime. I think this is going to be a cool metric as well. We'll put a little note up here. Only just sells right. Okay. So lifetime, we'll have to do, let's assume there was some cash in here because you want to see, hold on, 3. So technically, 75,000 gets you to the end here. 675,000 allows you to get in all these funds and not have to put in any more money. This is all you need up front. So that's one thing I wanted to show is that happening over time. And you can again adjust the assumptions so that the second, third, fourth, fifth, sixth funds start whenever by putting in a negative here. I'm going to put a note on this. Note. Okay. Now the question is, how do I zero this out the best to do an internal rate of return? I guess I do put a space here. Aggregate IRR. And it's going to be just this minus this. And then, so this is only possible for the first month. The rest of it, it can just equal Let me see. And I guess you would do plus the change in cash flow. And then for this, it would just be equal to the change in cash flow. There we go. Okay. And we could do the aggregate. This is the same calculation. And that should still work. Let's say we even do one on the very first month. Let's start this at the very beginning. So we got 150. So what happened here? These need to zero out, so we did something wrong. Let's see. 15 minus, oh, okay. So this minus this plus this is the calc. Wait a second. It should just be 150. What am I missing here? This plus this plus this. There we go. Same here. Now, does that make sense in all cases if I zero it out? No, it doesn't because, all right. Oh, wait a second. I can just reference, what am I doing? I just reference the cash flow like that. So now whatever this is doesn't matter, but this was used in case you wanted to see, okay, I need 224, 538, and then in that case, it covers me. That's the total cash I need if I invest the future proceeds. Like here, we've got an exit in June, and then we have another entry and we still have some cash left. And then we go on, save, 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 wait, and then we have another exit, and then we have another entry. And your entries, you can see how they can get bigger and bigger without you having to contribute any more capital, depending on if you've been drawing or not. But I'm going to set these at 0 for now. And now I can do a calculation here, which is X IRR, and we're going to go values over here. And this is going to be the monthly. Wait, no. I think this converts it to an annual. Yeah, 74%. That's definitely annual. And we could do the same thing. Oh, shoot. Same thing here, but bring our date up. Okay. Perfect. So LP's aggregate is this 75. And we could also put project level, which is just everything. So there'd be this plus this. So if you just wanted to look at the cash flows of the project itself and not look at any of who contributes what as far as LP and GP, we can do this. This will always be in between the investor and sponsor. All right. Wow. So for the first one, LP's actually got a negative rate. That's kind of crazy. Oh, let's see. How do we structure this first one? Let's say we just do pari passu, so 87. Still negative rate. So pari passu, um, and if you stay in the same hurdle, the IRRs are the exact same. Now they'll change if these splits get different, but see in this case we never get past the first tier, even with the exit. And let's see, I just want to make this positive, so let's see. Cash flow 1. -95, -90. What are we doing here? Hold on. Hold on. This shouldn't be. Okay. We might have had a error when we updated the calc for just for that one, because I was gonna say it makes sense that that was negative. So row 28 is cash flow. Why are we going to month 1 as well? 4. Ah, I see. Okay. So this has to be at least 1. The start of construction date and revenue cannot be the same, because if it were, you have the cash going out and happening in month 1 instead of 0. So then revenue, so everything tries to start into month 1, and we don't want that. And you can see this is still fine. The revenue still starts. So you start in January is the essential start month, and then you have cash coming in. And that's one of the caveats of trying to do this mapping. So it's just this should never be 0. Start of construction, purchase, or acquisition. And that's fine if there's no construction, just revenue is always going to start 1 month after the purchase, which is probably right anyway. If you buy something, you got to give it a month to get set up and everything. So never set this at 0 and you're fine there. Now let's look at the internal rate of returns. Okay, that makes more sense. Let's put all these at 80. And if we put all these the same, this is another check. Make sure everything's right. So in theory, if these are all the same, let's see, these are, what's it called, what else is different here? 60, 1111, 4, 468. Oh, I know. These have to also be the same, so let's do 80 on this. Dang it. Okay, I guess we're doing borders here, so that's fine. We'll just copy it over. Now this is just checking to make sure all the logic is working same on the same numbers. I guess it could be an issue with the XIRR function causing a little bit of a variance with the timing, but it should be pretty close. 37, 27. Well, the numbers are different for one. Okay, let's get this check done with. I'll figure out what's going on here, and then we're gonna extend this out for 15 years. I just want to see what's different. So 462, 1850. Next one is 367.14. So 1836 on the second one. 1836. Okay, here. So why are we different? Ah, that would make sense. The cap rate on acquisition cost and then square foot. It needs to. So it's saying there's construction, there is development. You're also acquiring property or the land or some or a building that's going to be redone. Okay, what's there's this is different. Excel's trying to be too smart here on the drag. 213. That's the same. Same. Okay, now let's go. Okay, almost the same. The last one, I'm assuming it's because it doesn't go as far as the other ones. Maybe. One, one. So they should be all the same in theory. 37, 37, 7, 37, 5. I think it's just XIRR. Because all those should be identical. Now this is odd. Why is this so different? $967. Month 15. So why is the last one exiting in 15? Oh, another issue. So months held has to be the same. Okay. Okay, now they're pretty close. They're within 0.1%, which is just, I'm assuming this is the different months of the year. Like some months have different amounts of days, so there's a slight variance because of that, but these are essentially identical. So that's a good check to make sure if we set all the assumptions the same, even though these are happening over different time periods, the timing of them is all the same, so they should have the same internal rate of return, which they do, as long as the cash flows that actually happen before the end of this. Okay, great. We're all checked out here on our balances. That all checks out. That looks good. Yep. So I feel very good about the structure and the references. They all have to be right in order for what I'm doing to match to that degree of a variance. So the next thing I want to do is let's extend this out another 5 years. And we're just going to have to do this on each tab. I think this is worth it because you might want to spread your funds out or whatever. Let's just go down the line here. Should be pretty simple. So we're going to go 15, almost perfect, to GB. Then we'll set these at these 13. Yep, 13. Okay, so we go to GB. GB. There we are. Column width 13. Now, the acquisition cost is more than the exit in these cases. Let's put this, let's change that. So we're going to put, it'll be real simple. The quickest way to change that is increase the revenue. Let's do 102 a month per unit. Watch how fast that changes. So now, yeah, now it's positive. Exit for 2 million. Bought for 2313. The IRR is probably very low. It's not terrible though for the annual. Not terrible. The annual summary is going to look a little bit easier to, it'll be easier to digest than the monthly. All right. So where were we? 2, number 3. Did we do this one? No. So let's come on over here to BG, or what was it? Or GB. I think it was. Yep. Now what's going on with Fund 3 here? This is zeroed out, but Fund 2 did not. Cumulative cash. Well, that's why. Hold on. Another reason why we do this. So this equals that. This equals this plus the previous balance. And let's just make sure these are all right. So we'll just paste it in. AP29 plus AQ28. So this is fine. And this is fine. 29. Yep, that's right. 165, 165, 165. Make sure this one is. They should all be the same. Okay, good. Where were we? Three, fourth fund, fifth. The reason why I saw this is because when I was just playing around with the months, I realized 10 years might not be enough. If you're doing up to 6 funds over time, you might need more years. So now you've got it. Oops, 13. Okay, looks great. Looks great. Now you can spread this out a bit if you wanted, like maybe hold on for 24, 7 times 6, 40 months. We added 60, so yeah. We could do like a 2-year hold on these and it would still fit. Or it should. Oh, we gotta update the cash flows as well. So these need to go out. Now it's gonna be well, so once I do one, I can update the rest pretty easily. Uh, let's see, how far does this need to go? What's the end date of number one? December 2036. Oh, I almost had it all. Now, what are these spaced at? Looks like 13 as well. The trick is now all of these have to be updated to column GB, but I only have to do it for this one. I can copy and paste these side numbers all the way down to the other cash flow tabs. And same with the IRR calculations. I almost need to do a to-do list within my thing here so I don't forget to update references. helps. All right, so I can just go under the total here and copy and paste. Wait, hold on. We need to do the checks as well. So this has to go to GB. Now what this check means is 12.6, that's fine. What it means is um, never made it past the second hurdle. Yeah, never made it to the second hurdle. It means you got up to 12.6% only, so you're never going to get past the. You've got 75-25 split, you'll never get to the tier 3. You can see here we got to tier 1 and then tier 2 at the very end, but never tier 3 in or after that. Which is fine, but just so you know what's going on with the logic. Okay, I think everything's out GB, so now I can just copy and paste all of this. Just make sure these are all just regular references. Okay. So contributions, update, update, update. And now we gotta drag this over. Now what happened here? Uh, up. Uh, hmm. So matrix tab, we gotta come. This has to go down further, first of all. We added 5 years, 60 months, so go down to 180. And same with this. Matrix 2 has to go over. Somewhere around GB, I'm assuming. Yep. So that's fine. Let's go to matrix 2. Oh wait, we just did that. So these are good. Okay. All right, we're making progress here. So now, okay, looks good. 12.7 numbers are back to being the same. So now all I have to do is drag these out to GB, and we have now officially extended the entire model. So once we know all the formulas work and we're getting the same output based on the same inputs, I'll start changing the inputs and making sure we're picking up the right values in each fund, which I'm pretty confident we are, but we'll test it. All right, put this right back to the top. Get these back to the top. And now if we go over here, all right, so we are LP's 12.6, GP's 13.5, and so this is because the LP actually never reaches their second hurdle. So even though they only got 12.6, the general partner still got their share, even though whatever it was, the cash split, they got this 75-25 from anywhere if the LP goes anywhere from 10 to 15. So that makes sense. I wonder if I should put those hurdles on this tab. I don't know. And why do these look weird? Calibri. Why? How do we get Ariel in here? It should be Calibri 11. This is all Arial? It's because I had to find the other workbook. Let's change these all to Calibri. I like that better. I can zoom in a bit more now. This is up there with the most complex model I've done for sure. And I think this is one of the most useful ones that I've ever built. And that's why I'm going to price it at $45. And even though this is worth literally thousands easily to try to replicate it. Like it would cost a lot to get this logic in here. Okay. And what about these? Are these Calibri? Yes, these are. So we have the fund, we have LP and GP. They can see kind of, you can kind of plan out if you have a certain amount of money, how far does it get you? How do you have to adjust the assumptions and splits to make it make your contributions work? Let's do an annual here. Copy this. I'm not doing an annual of all of 1 through 6 and cash flows 1 through 6. Those will stay on a monthly basis. But the data from those are aggregating into here anyway, so it's like we are. We'll do monthly cash flow, all funds. This is annual cash flow, all funds. Here, okay, so we only need 15. This is a 15-year annual. That's a monthly, so we can clear out the rest of this past 15 years. We just need this and convert this to a year. And make this 13 instead of 1. See, quarters don't matter. Let me check something. What I do on the year here? Ah, okay, that's fine. So we simply just do a sum ifs. Sum ifs on each line item of the monthly if the year on this matches the year. We lock the date reference. Drag ourselves down here and over. There you have it, the entry and exit aggregated on a yearly basis. Let's see, starting bank balance is always going to be whatever you put in here. So this is reference. Copy this down for the LP side of things. Also, see if we can condense this to see it all in one screen. See 12.5. That works. Honestly, this would look better all the way at the top here. Then I could bring this over. Oh, I can't do it on this one though. I can do it on the annual, so we'll keep it like that. What else? So this is, that's fine how that is. Whoops, forgot fund 6 down in here. Let's make sure we have it. Let's add that here as well. 6. Where's fun 6? Um, it's here. What? Okay, so we have data in and out in year 13. It's right there. Fun 6. We got it there. Okay, so okay. Where is it? E6. So 6, E6 is that, and that is referencing this. This is referencing this. Okay, so that's there in November 2032. Oh, hold on. We never drug over our monthly, so let's drag this over to GB. Set this to 13. Okay, now we got fun 6. Put this over this. This needs to go out farther to GB as well. And when you get cash flows on a monthly basis and do an internal rate of return, it's never going to be the same as an annual. It should be somewhat close, but it will never be the same. All right. See, 12, 12. Uh, 13. Kind of curious about this calculation because these should technically be the same. I guess because monthly and annual, the conversion, we got slightly different numbers. But here, we can just do an IRR, honestly. These are just annual numbers. Yeah, 13 and a half. This should be 13 and a half. 13.3. Okay, oh, that makes sense because some of these, the sponsors got a little bit of a higher return rate. So sponsor LP. So there's the annual basis. So you can see it all wrapped up in a nice 15 column thing. There's each fund in and out, in and out, the aggregate. Love this logic. This is so cool. Monthly, make sure this is, let's say this starts at 500. So a little surplus there, 2 million here. A little surplus there. Just make sure these, yep, 5 and 2. Internal rate of return still the same. So you see the monthly is a little bit different, but um, it's close. The monthly is more accurate if there are monthly cash flows. Now we start to change some things. Let's just do a smaller starting acquisition on each of these and see what we got now. So 449, 442, 434. So that's getting less, so that's good. If we look at it on this basis, we can actually see the right amount. 462, 52, 42, 32, 22, and 12. Perfect. So those are all changing correctly. So that means all the references work exactly like they should. We could also test exit cap rate. Let's do 4.1. So now the exit values should be a little bit higher. Let's check the exit value. So we're at 2766, 2699. So it's getting lower because if we raise the cap rate, that means the exit value is actually a little bit less. Higher the cap rate, the lower the value. So that makes sense. So 2974. Sorry, on the net exit 2766, 2699. Perfect. Then the next one should be a little bit lower. 2644, 258, 2525, 2469. Perfect. Okay. So we've extended this successfully for 15 years. It looks like all the logic's working. I think that's enough time to do this kind of analysis. You can really see based on what kind of investor sponsored deals you're getting into, what kind of cash you might need to do such a strategy over 15 years of getting in and out based on, you can structure each deal differently for who contributes what equity and then how that's repaid. Um, you see now that the IRRs are a little bit different as I started changing some of the assumptions slightly. Now kind of odd. So this is going down, up. Let's do a bigger number to make sure. Like, let's do 4, 5. We really want to see the difference, and really the bigger impact is the initial startup cost is going to have a bigger impact on the internal rate of return. Oh, that actually had a great, huge impact. So 12, 2 minus that. Yep, that looks better, or that looks like what I would expect to see. I'm wondering wondering if we want anything. So we have initial equity contribution share. We've got cash. Required. We've got internal rate of return. What else could be interesting here? We're definitely going to have to do some visualizations, and where can I put those? I'm actually going to put this is going to be called global, because I want to put some data here that's interesting, or some charts. Let's lower this. Let's say this is 100,000. That should help tremendously on, yes, only the last one's negative. Let's say the last one you have maybe you're doing 115 square foot for revenue, rent revenue. Okay. Good. So it's good just to play with the different funds to make sure it's changing like it should be. That's a good eye test. I've also already made all the assumptions the exact same, and since these are all in the same time frame, all the numbers are exactly the same when I do that. That's a good check. Um, well, I guess let's start with some visuals because all the logic and all the hard crap is done, which is great. It's really an in-depth model, so we'll do. What's a cool visual here? I want to show like the stacking. Let me think about this. So, let's see what this looks like. If we do a monthly, we're gonna actually take the whole data here. Let's just go monthly, all the cash flow for the sponsor. Okay, that's kind of hard to see. We might do an annual there. Uh, let's format this slow, make this low. I always like the light gray background. It's pretty simple. So this is what. So it's kind of hard to even see what it is because even if we did like a line, let's try to do a line chart. Yeah, it's still going to be hard with the line chart because it's just 180 periods. It's kind of cool. I mean, you could see here like your initial entry, then you've got cash flows, then you've got your exit, then you've got the next entry here, which is your cash going out, then cash flows, and then exit. It's kind of interesting. I mean, it's just so small. I think we're gonna have to. Man, I want to do visuals with the assumptions. Let's put this on the assumptions area. And I want to make it huge so you can really see like. Oh, that line's kind of getting in the way. So here, it's still hard to see the cash flows. The cash flows per month are just so much smaller than the exit and entry costs. Hmm. I think it's a cool visual though. It was almost easier to see it on, like we had it on the global tab. Like right here, you can kind of see cash flow, cash flow, cash flow, entry, exit, exit. Yeah, actually, when we spread it out, it gets worse. It's better when it's actually tighter. That's perfect. We'll just do a monthly and annual. So here's monthly, um, cat monthly change in cash, and that's assuming no bank balance is just the actual deal, the deal's going on. And you can then see what your minimum equity is. Here's actually, you don't need that much. If you put 0, you need 282,000 to do this entire deal all the way through. And then in theory, will never run out of cash. You'll always have enough to do the next deal. Now here you can see, I wonder if I could show that. So monthly change in cash flow. This is all for the sponsor right now, but we can also do the same thing for the investor. So what I think is interesting is not this. That is, but let's do, I want to show the cash flow, which is essentially going to be our, I guess we could pick any bank balance. That's going to include your initial bank balance amount you put in. So actually, no, we want to see this number. This is not including any cash in. So this is your equity requirements here. No, I don't need this. I need the cumulative amount of this. So, and that's going to be called running, put the aggregate, cumulative cash flow. Now, this should be a bit more of a telling visual here. I really want to capture the idea of investing, exit, reinvest, exit, reinvest, exit, and it really, there we go. That's what I want to see. So you invest, first deal you exit, now you've got a positive cumulative. You take some of that, reinvest, you're still positive. Exit, but then you reinvest, so you take some of the exit proceeds to do another one, and you build and build and build and build. And then you finally get to 1.2 million, and you only had to start with 278,000. And that's how you built up. That is perfect. That's what I want to see. And does this look better as a line chart is my question. Yes, I like that line chart. Smooth line. That's very cool. Yeah, that works. That works really cool. So these again can be changed on a per deal basis. Maybe over time the LP is going to contribute less. You're going to contribute more. Let's look at what that looks like. Let's say 5% each time. And what happens there is your your internal rate of return is going down, but your total cash return is actually that'd be going down every time because the cash splits are based on hard-coded percentage splits in each one. So if you were contributing more, you'd probably have a much different profile here on the cash splits. So we'll leave that to be manual, and I don't feel like going through and adjusting every single one. Okay, so this is there. Change all your assumptions here. You can see some of the aggregate results here of how you kind of grow. Monthly change in cash flow. I don't think we actually need this. I'm gonna put this on an annual basis though. Let's look at this on an annual basis. It might be a bit better. Yeah. So fund 1 through 6. Format this to a yearly. Come on. There we go. So I want this to be, oh wait, it is yearly. Why? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Why is there 16? I'm confused. What is this? 1. Hold on, let's go to the annual. There's 1, 2, 3, 4, 5, 6, 15, 2022, 37. Let's look at the data again. So just don't include that. Delete this. I'm trying to see why are these so far? And then the exit, you just have exit. But this seems way too much space. Like there's. Let's go to a line, see what that looks like. Whoa, that looks crazy. So that's the. Whoa, that's cool. What in the world did we just make? So, oh, I see. So fund 1 starts down here. Then here's the exit. And then it's 0 from there. Fund 2, here's the entry. Here's the exit. Cost, exit, cost, exit, cost, exit, cost, exit. I think this can be a better bar chart, honestly. But it needs to be wider. These need to be wider. So 1, 2, 3. See, on a yearly basis, so you have some of the cash flows happened in this year, and then the actual exit didn't happen until here. And then you've got an entry there, so it's kind of, you're conflating. Well, let's see. I guess that's just saying it happens over 3 years. 1, 2, 3, 1, 2, 3. So the issue is these happen over 3 years usually because it's 24 months. So what's the best way to structure this visual? 1, 2, 3, 1, 2, 3. This now makes sense to my eyes. 1, 2, 3, 1, 2, 3, 1, 2, and then what happened here? Why did we skip it? Looks like it skipped. Make these vertical and see what's going on. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Hold 1, 2, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. What am I counting? 22, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Okay, I've lost my mind now at this point. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So 2022 to 2037 is 15 years. Why? What? Did something get double counted? 1, 2. This is not good. What am I missing? 1, 1, 2, 2, 3, 3, 2024. Ah, okay, here we go. 32. Oh shoot. Somehow we missed a year. Uh oh jeez. So this needs to be 1-1. Oh, hold on. Year. There's the year. 2 now 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. What is going on here? Oh, I put 12, 13 instead of 12. Now that'd explain it. Okay. So my chart was trying to compensate for my labels being having 13 months in a year. All right. So this is a nice visual, I still think, of each deal. And you see it all in the same timeline, entry, exit, entry, exit, entry, exit. And here's the aggregate effect of all those cash, doing the first deal, exit, then take some of that cash, do the second deal, exit that, and this is how you kind of go up depending on the structures of the deal. Now I made everything different, the assumptions, so however you define all your self-storage acquisitions and the revenues and the costs will all affect all of this. Yeah, I'm keeping this here. This is nice. So this is annual cash flow per deal. And that makes sense. And now we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Perfect. This is the monthly. Now, let's see if we can make these wider. I want to make the bars wider. Ah, here we go. Like a 5. Does that work? 5. I gotta do it manually. Okay. is it changing colors? Uh, Hold on. Undo, 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 undo. Okay. So that was fine. Sponsor. Next one. This will be fun 5. Fun 6. Or 4. 1, 2, 3, 4. Okay. Why is there dots in these? I don't know. Whatever. So entry, exit, entry, exit. Love it. Perfect. We could slant these a little bit, maybe minus 20. Oh wait, it won't let me. Why won't it let me slant? I guess I could do it like that. 22, 23, 24, 25, 26, 27, 28, 30, 31. Okay, it's fine. Well, see, these are still kind of offset, a little weird. If I make it wider. Uh, Stick to minus 30, I guess. And the last 2 years don't have any data because we actually end. I guess I could extend this out to like 36 months. So now you got a couple years in between there. Actually, we'll put it 40, get it at 2036. There we go. So now you can at least see where each year is on the timeline. Cash flow per deal, cumulative cash flow. I think that this is really the gold here. This is what I want to see. These are structured throughout there. This is all automated. Nothing's done here. It's just the data of the P&Ls of each deal on the same continuous timeline. Yep, these are formulas. These are hard-coded. Now, so this is sponsor. I'll add the investor onto these, same type of chart, and I think we're there. Self-storage model done. Just a couple visuals, and then let me make sure I clean up all these checks. That looks good. 21, 170. Oh wait, what's a good check? Uh, 1370, 1370. So that matches. What about this? This is 3141, 3141. Perfect. That's good. Just gonna put 0 in for these as the default. Okay. And I think that's it. This is a really great model. I'm so pumped to get this one out. I think it's going to be super useful for a lot of people. Like I said, essentially all I'm going to add is a little about or instruction on how to use, and I'll add a couple more visualizations, and I'll do a overview video later this week, but this will be ready by the end of the week for sure. All right, I am headed off. I do stream every Monday at 5 p.m. and I'll be doing models as well as maybe custom work, or I mean not custom work, customizations to past models if I get a lot of feedback for something. You can also come in here and just say, hey, pick my brain. I don't mind talking while I'm doing this stuff. All right, I'll see you on the next one.